So, we're going to talk a little bit about how companies might go about committing accounting fraud, because that's one of the more fun takeaways when you learn about accounting is how companies might go about trying to commit accounting fraud. So, we're going to focus on two common areas where companies typically commit fraud, and that's revenues and inventory. So, let's first talk about revenue. There's actually a few things companies can do as it relates to revenue or trying to commit accounting fraud related to revenue. So, one, they can book just completely fake, completely false revenue journal entries. So, it looks something like this, where they're debiting accounts receivable, perhaps, and then crediting sales rev, because this would cause a company's revenue to go up. And typically this is done using accounts receivable instead of cash, because physically they're not getting the cash because it's fake. So it's easier to try and hide this through accounts receivable. So that's one way, just completely false journal entries without any valid sales transaction. Another really common way to try and record inappropriate revenue is leaving the books open longer. So let's say it's a company's year end and they have a calendar year end. So 12/31, so it's the last day. What they can try and do is, if they want to increase their revenues for that year, they can leave their books open, so to speak. So revenue transactions, sales transactions that are happening in January 1st, 2nd, 3rd, 4th, or 5th, they can take those transactions and actually pretend like they happened and backdate them and pretend like they happened in the prior period. So it inflates revenues for the last year. Another thing they can do is recording revenue when services are still due. And so it's not quite booking completely false sales transactions, because it might actually relate to a real customer, but they're not actually providing the services until a future date. So they haven't really earned the revenue yet, but they might go ahead and book it now to try and get it within the period, knowing that this is eventually going to be a real revenue transaction. And so those are a few ways that companies can try and boost their revenues for the current period. Typically, right, the whole reason why they would want to boost their revenues is because if your revenues go up, that also translates to your net income, your profit going up. So that is the main motivation there. Now, another really common area for accounting fraud is inventory. And the big issue here is just recording or saying you have more inventory than you really do. So fictitious inventory. Now, auditors are supposed to go to companies' warehouse sites where they hold their inventory and check their inventory and do inventory counts to try and examine inventory. And the inventory that a company says they have, the auditors check and say, okay, you really do have that inventory. But there's still a few ways for companies to try and get around that. One, typically auditors have to announce what warehouse they're going to do the inventory check, to do the inventory count. They can't they can't just show up and completely surprise the company. So they do usually have to give some advance notice to the company, even if that's just a few days. But that few days where the auditor has to give some kind of advance notice, the company could try and move around inventory from different warehouses, from different sites, to conceal that, they are saying they have more inventory than they actually do. And then another way that companies might try and get around this, even though that auditors are coming and counting their inventory, is they might have boxes in their warehouse that are unpacked. And so the auditor needs to be careful that they are examining these boxes that the company is saying is full of inventory, but they might actually be empty. So it's important for the auditor to check unpacked boxes as well. And auditors do also do testing, not just to check inventory, but also around revenue too. So they'll do special tests to examine revenue, make sure that revenue transactions have support, right? It's an actual valid transaction. They'll look at transactions that are around the cutoff date. So right before 12/31, right after 12/31. And another interesting thing they do actually is they can check transactions on holidays. So normally, right, if it's a holiday, the company is closed. So no one should be at the company site or no one should be logging on. So what auditors can do is they can check and see, oh, were there any transactions booked on holidays when potentially no one's in the office? And so that might alert an auditor to fake journal entries being posted if they look suspicious and they're being booked on holidays. So I hope you enjoyed this little chat, a little bit about accounting fraud in these two areas, revenues and inventory.